So why do you think there's been such a surge of secondaries funds?
And yet only about 10% of the secondary market is traded in those stocks. 90% is in the unicorns.
Welcome back to another Real Selection Private Equity podcast session. Today is Richard Brekka, managing partner and co-founder of Second Alpha, a secondaries investing firm. Richard is going to put to bed the discrepancies of what secondaries investing is and give us a clear picture as to all the different options in secondaries and what these guys do. The value of what they do, but also how they're operating and how they've found a really good, clear niche in their space. So let's jump in and welcome Richard to the podcast. Richard, if you could give us a brief insight into you, please.
Sure. My name is Rich Brekka. I'm the co-founder and managing partner of Second Alpha Partners. I started with this business with my co-founder, Jim Sanger, in 2012. We had both been venture capitalists for a long time prior to that. And in a transaction that we worked on together, we had a co-investor decide that they needed to liquidate their position. And we made a tremendous amount of money on that secondary purchase. And the light bulb went off that that's a business that we could do and provide liquidity to shareholders of private tech companies.
Like it. So what's one mistake that you see private equity firms or portfolio companies making, and what would you suggest to correct them?
I think for a lot of funds, is holding on to investments too long. Especially in venture funds, they're holding on to assets. Some of the funds are running as long as 15, 17 years. And because the company hasn't performed or hasn't developed enough. And I think that there is a change afoot to try to liquidate and realize value sooner. And I think that's changing in the market. And part of the reason why we have a business that we have today.
So the secondaries market, I'm going to dive into a little bit of what you just shared there, but the secondary market, just give us an explanation of it, something nice and clean that everyone can walk away and there's no ambiguity, because the secondaries market has been explained to me by multiple people in probably 10 or 15 different ways. So I would like a full, clear explanation as well as no doubt a lot of the listeners.
Absolutely. There's really two different secondaries markets that we're talking about. One is the secondary market for funds. And those can be where a limited partner is selling their interest in a fund. And that's a big market. It's well established. And then somewhat newer is what they call the GP-led or continuation funds, where a GP creates a continuation fund to replace the existing limited partners with new limited partners as a way to create liquidity at a fund level. That's a whole separate business from what we do. We do secondary direct investing, which is actually buying stock in companies that are private and providing liquidity to the shareholders. And that's a newer market and a different secondary market than what most people refer to when they talk about secondaries.
So why do you think there's been such a surge of secondaries funds and movement towards this space? What's been driving that kind of underlying, growth of your industry?
In the fund secondaries business, it's been the big driver has been that there's a lack of liquidity for GPs to get liquidity on underlying companies. And so they're doing GP-led secondaries to provide liquidity for those limited partners and allow them to get out of those companies or out of those portfolios. On the direct side, this is a whole new business because there hasn't historically been a lot of liquidity for private tech companies. It's started with the unicorns, where most of the secondary transactions in private tech companies are in the companies that are in the unicorn class. So over $1 billion valuation. That's where most of the trading has occurred. And the reason it's occurred is that those companies have chosen to stay private much longer And in order to provide liquidity for existing shareholders, they've had to create a valve for liquidity for those shareholders. But most of the secondary direct is in those unicorn stocks. When you look at some of the trading platforms like NASDAQ Private Market or Forge, what they've said to me is that about 90% of their transactions are unicorns. Unicorns in aggregate, there's call it about 800 unicorns, have a aggregate value about $2.3 trillion. And it's a big market. There's a lot of value there for liquidity needs. But there's another market just below that, which is where we operate, where companies between $100 million and $1 billion valuation, and there's about 3,800 companies at that level that aggregate about $1 trillion. And yet only about 10% of the secondary market is traded in those stocks. 90% is in the unicorns.
Interesting. So obviously a huge opportunity, and understand why you guys have dived into it. So is your market predominantly for your space of that, as you mentioned, the newer element of things? Are you predominantly working on the basis of private equity firms' investments, or are you going to normal Tom, Dick, and Harry in order to take a cut of their business?
Right. So what we do is we go directly to the companies themselves. And we actually have a large database that we've built over 12 years to identify companies which we think are interesting. And the profile for us is typically a company over 100 million in revenue. They're typically over 10 years old, growing 25% or better, cash flow positive, and they're just executing the business model. They've raised all the capital they're going to need to raise. But when companies get to that age, there are a lot of investors. There are founders, there are angels, there are early small venture funds, there are later venture funds, there are employees, current and former, and there's a lot of people on the cap table that would like to get some liquidity, and yet the company still has another 3 to 4 years to run. And so what we do is we go direct to the company, we talk to the CEO, and we talk about his shareholder base. And are there any shareholders who would like to get some money out of the company currently? And invariably, when you talk to the CEO, he will say, yeah, there's a guy. There's always a guy. And that shareholder wants to get liquidity. And the CEO really doesn't know how to help them because they're not a unicorn company. They may be a great software as a service business model and growing and a B2B type tech company, but they don't have the brand name that's attracting investors. And they don't know how to get an investor like that out. So what we've found is that we can provide a great liquidity solution, and the CEO is very happy to have us come in and help. And so what we say to him is we'll take care of that guy. We'll get liquidity for that shareholder. And very often the shareholder doesn't want to sell everything he owns. He only wants to sell 10, 15%. He's just trying to satisfy a financial need. And the financial need can be anything from paying for college, buying a house, divorce, invest in a new business. There's all different reasons an individual shareholder would want to sell. And so we'll take care of that. It doesn't really matter to us the size of the investment. I mean, we're happy to do $1 million purchase because what we've found is that where there's one guy, there's others. And so once we provided the liquidity for that seller, we continue to help the company and provide liquidity to other sellers, and we aggregate, and we'll build a $10, $15 million position that way. And the company's happy because they've got an investor coming in replacing some old tired shareholders that is an institutional fund like Second Alpha that understands the company's business and is there basically to support the management and the CEO's journey to the ultimate exit. And that's the model that we execute. What's interesting is that most of the market is focused on big companies, unicorns, and big dollar transactions. and there's very few investors that want to do what we do. But we think we provide a great service, and as a result, we have tremendous relationships with the CEOs of the companies that we invest in.
95% of all business problems are people problems in disguise. Over the last 6 months, I've been intently writing a brand new book, all focused on the experiences that I've collated from some of the top private equity firms and investors on how they interview and select top executive talent for their portfolio companies. To go to the waiting list for this book and receive a free copy for the first 100 added, please check out the show notes and get your name on the waiting list today. There's a few questions on the back of that, but I'll kick off with, why do you think there's not a lot of businesses doing what you're doing at Second Alpha?
In order to get access to a company, it's a lot of work. You have to get directly to the CEO in order to actually understand the business. Companies that are private don't have to disclose their financials. So in order to be able to make an investment decision, you have to get access to the company, you have to be able to talk to the CEO, and you have to get financial information. And that requires building a level of trust. And so it's not a simple process. And then you also have some restrictions that the company has a right of first refusal on any share being sold by an existing shareholder. And after the company decides whether or not to exercise its right of first refusal, the existing investors also have a right of first refusal to decide to buy the shares or not. And so you have to know how to work the process to be able to provide the liquidity that is required here. And so for us, we always go direct to the CEO. And if we're here to solve a problem, and if we can help the CEO solve a problem, and that's what he wants to do, that's great. And we also talk to the existing shareholders that have the right of first refusal as well, and say, if you want to buy this, you don't need us. But if you've got your fill of investment in this company, we will step in and we'll be the liquidity provider. And given our background and performance and reputation, we're welcomed in to do this at these companies, and the investors are happy to see us be a solution provider for the company.
And so the portfolio that you end up then building, how much involvement do you have, assuming being everything's going to be minority? What kind of support are you offering from that perspective, or is it literally we're just taking people off the cap table and we're here as a silent partner, or maybe both?
No, we always say to the CEO, we're here to help. That's the number one thing. And the first level of help is solving liquidity problems for the shareholders that he has that would like to get some liquidity. And we do that. And then after we've done that, we look at, where is the company and how can we help the CEO? So I do a lot of CEO introductions, introducing one CEO to another that can help each other's businesses. And that's very much valued by the CEOs in our portfolio. The other thing is we're a fresh set of eyes on a company. And so a lot of these companies are over 10 years old, and the CEO appreciates having an investor that can give good advice. And so a lot of times, the CEOs will say, the reason we like having Second Alpha as an investor is that they're a trusted advisor, and we can help them with issues they're working through, managing their businesses. And then we also help them as they look to their ultimate plan to exit, usually through a M&A event, which may be 3 or 4 years off in the horizon. But if you're looking to exit a business in 3 or 4 years, you need to be starting to build the strategic relationships with potential acquirers that initially start as a commercial relationship and then ultimately can lead to being the strategic buyer of your company. And so we do everything we can to help the CEO along this journey.
So those kind of size businesses, you guys are pretty niche with regards to what you're doing here. So you have a bit of a unique access into some of the challenges in privately listed businesses that you mentioned aren't listed on. The financial information isn't on there because they're privately owned. Obviously classic, how do we increase revenue? How do we increase EBITDA? But aside from that, what are the kind of major challenges or the most consistent challenges that you see in the types of businesses that you invest in?
Many of the companies are going through, if they've been around for over 10 years old, they started with one product that got them in business and it got them to a certain level. And then they had to pivot and they had to develop a next generation product or roll out a portfolio of products that continue the growth rate of the business to make it valuable. There's a lot of different changes that occur in that life cycle. Most companies don't start with one management team and finish with the same management team. And so there's a lot of change during those 10 plus years of founders being replaced with CEOs, different CFOs, different head of sales, engineering operations. Those are all challenges that they go through. And sometimes it's learning how to adapt to the market and take different approaches in order to be able to continue the growth. What got you, the first 10 years won't get you the next 10. And so that's a lot of what they work on, and where they have to focus their efforts to drive their business.
Absolutely. And so what's your kind of mandate from your, assuming you've got capital investors? Are they saying to you, do you know what, Richard, don't invest in anything because this is quite a narrow space to get involved in. It's opportunistic with regards to the platform. Do you have a certain industry specific that you have? I'm going to assume revenue sizes and things come into play, but how do you kind of structure your go-to-market strategy?
Right. So we're North America focused. We don't invest outside of North America, and we're focused on technology. So at the core of every company is a technology platform, software, generally not any hardware businesses, and it's across a lot of different verticals because technology can solve problems for a lot of different industries. We're not in biotech, we're not in real estate per se, but technologies that serve real estate industries could be an interesting area for us. So we're very diversified from, fintech, insurtech, cybersecurity, data analytics, ad tech. We cover a lot of different verticals, which is part of what we're doing. We're building a very diversified portfolio. When we talk to investors about what we actually do, the way I describe it to them is we're buying into these great, over 10-year-old companies, and we're curating a growth equity stage portfolio. But rather than pay the price of a primary investor coming in at that late stage and paying a high price, we're entering through a secondary purchase at a substantial discount. And we're coming in after the growth equity. So in effect, we pay less than the growth equity did, and we have a shorter time to an exit. So pay less time, higher return for the investors. And that's what we do.
Sounds like a dream, Richard. Sounds literally as easy as that.
That's right.
Okay. So perfect. So with yourself, Richard, what do you read? What do you watch? What do you listen to that you recommend that others should check out?
Oh, that's great. We are constantly looking at different industry sectors and reading up on technology developments, and really interested in what companies are coming up behind and innovating, and how that can impact a industry sector that we're looking at investing in. The reality is, for a lot of these new technologies, it's going to take 10 years until they get to really great scale. But they can have a tremendous impact on the marketplace. And so looking for those companies and understanding what's going to affect the industry, and specifically what's going to affect portfolio companies, during the duration of the time that we're investors in those later stage companies.
What industries are you kind of keeping an eye on? Obviously the artificial intelligence mode at the moment is interesting a lot of people, but I'm going to guess for you guys being at kind of 100 million plus, it's probably a little bit of play in that one before that happens. But are you beginning to see anything between, the boom of the cloud as what you'll now see as a lot of the kind of companies that you'll see facilitating and supporting that industry? Is there anything in between AI that you guys are researching and seeing as the next 100 million type revenue companies? Or is it literally we're waiting for that AI boom to the first one-person billion-dollar company or something, as everyone keeps talking about?
Right. Where we look at AI is we look at where is it affecting portfolio companies, positive and negative, and what the company should be doing to actually improve their business with the utilization of AI to make what they do more efficient. I think one of the areas that we're really focused on is the efficiency model. So there is, over the last 10 plus years, been a massive movement to the cloud, and a lot of data is hosted in the cloud, but not necessarily efficient utilization of the cloud, because the cloud can get very expensive. And so data analytics in the cloud is an area that we actually focus in on, because we think there's a need for efficiency. Snowflake and Databricks have gotten very big and made a lot of money and revenue, charging it as a toll gate to every time you want to analyze your data that they're hosting, you have to pay the toll. It's great for Snowflake and Databricks. It's not necessarily great for the companies that are customers. So finding more efficient ways to create data analytics is an area that we're delving into.
Interesting. Disrupting the disruptor, the challenger of the equivalent of Uber in the cloud world. Sounds interesting. So Richard, if anybody wishes to reach out, how best do they get in contact with you, please?
Secondalpha.com is our website. We're based in New York City, and those are the best way. My emails are Brekka@secondalpha.com.
Simple as that. Well, thank you very much for coming onto the podcast, Richard, giving us a clean insight into the secondaries market. You've given me a 3 clear tier. I have been told about 10 different other methods of secondaries, which some of that went into fund of funds, and I've had many discussions, but I'm glad you've managed to clear that up. And, the interesting market that you guys are investing in directly into the private markets. That's really interesting. So thank you very much for coming on. Thank you very much for sharing your insight.
Thank you so much.
And for all our listeners, thank you very much for again tuning in to the Private Equity Podcast. Till the next time, keep smashing it, and thank you very much for tuning in.